Converting your S corporation to an LLC can offer significant benefits, but it comes with important tax consequences you need to understand before making the change. When you convert an S Corp to an LLC, the IRS typically treats this as a liquidation under Section 336, potentially triggering capital gains taxes. This is one of the most critical considerations in your decision-making process. Why do business owners consider this conversion? LLCs provide greater operational flexibility, fewer corporate formalities, and favorable partnership taxation options. Many business owners find these advantages compelling enough to explore conversion despite potential tax implications. Both S Corp and LLCs offer limited liability protection and function as pass-through entities for tax purposes. This means income, deductions, and tax credits flow through to the owner's individual tax returns, avoiding the double taxation that C corporations face. However, the conversion process itself can create significant tax events. When you dissolve an S corporation to form an LLC, the IRS views this as a taxable liquidation. The corporation is deemed to have sold all its assets at fair market value, creating capital gains or losses that flow through to shareholders. Several key tax considerations come into play during conversion. If your S Corp was previously a C corporation, assets that appreciated during that time may be subject to built-in gains tax if sold within 5 years of the S election. Equipment and other depreciable assets may trigger depreciation recapture, increasing your tax burden. And while both entities avoid double taxation by default, a mishandled conversion could result in distributions being taxed again at the shareholder level. State-level taxes add another layer of complexity, as some states treat S Corp and LLC conversions differently, potentially triggering additional taxes or filing fees. Timing your conversion strategically can help minimize tax impacts. Converting during a period when your business has a lower valuation can reduce the amount of taxable gain. This makes conversion particularly attractive for businesses in their early stages, before significant asset appreciation occurs. There are several methods to convert your S Corp to an LLC. A statutory conversion available in many states involves filing a certificate of conversion and articles of organization. This streamlined process legally dissolves the S Corp and forms a new LLC in one step, though it still triggers a liquidation event for tax purposes. Alternatively, you could use an asset transfer approach, where the S Corp sells or distributes its assets to shareholders who then contribute them to a newly formed LLC. This creates more administrative work and may have significant tax consequences if appreciated assets are involved. A third option is merging with an existing LLC if your business already owns one. This provides some flexibility in preserving entity history and contracts, but still invokes IRS liquidation treatment in most cases. Some business owners want the structural advantages of an LLC while maintaining S corporation tax benefits. This is possible by forming an LLC and electing to be taxed as an S corporation using IRS Form 2553. This approach maintains pass-through taxation with payroll tax savings typical of an S Corp, while preserving liability protections and structural simplicity of an LLC. To qualify for this hybrid approach, your LLC must have no more than 100 members, issue only one class of membership interest, be owned by United States citizens or resident aliens, and file the proper forms within 75 days of formation. Before proceeding with any conversion, conduct a thorough evaluation of your business assets, analyze the impact on depreciation schedules, review contracts that may be affected by the change in business structure, and consult with a tax professional or legal advisor. Converting from an S Corp to an LLC makes particular sense in certain situations, when you want enhanced liability protection through charging order statutes, when you want to liquidate assets ahead of anticipated growth, or when you plan to bring in new investors that might otherwise terminate your S Corp status. The decision to convert your business structure should balance immediate tax consequences against long-term operational and tax benefits. By understanding these implications and planning carefully, you can make an informed choice that supports your business goals while minimizing unnecessary tax burdens.